Part 4, business entities, different types of business. Well, first of all, there's a sole trader. Sole trader is owned and operated by a single individual, one person engaged in business. They may employ other people, but there's only one owner and one manager, and the owner-manager are the same person. Sole traders' business and personal affairs are the same for tax purposes. Sole trader can increase or withdraw capital from the company. They can introduce more funds into the business really easily. They can make what's called drawings, which is just taking money out of the business, which is capital that has been withdrawn. Sole trader suffers from unlimited liability. This means that the owner is responsible for all of the debts and losses that the company incurs. The financial statements are private. They do not get published. Nobody sees the financial statements for a sole trader. If we compare that with a partnership, there's not a lot of difference. Partnership is more than one person owning and operating a business, but the manager and the owner are the same, or the managers and the owners are the same. They can still employ other people. Very similar to a sole trader, as the partner's business affairs and tax affairs are the same for tax purposes. Partners have unlimited liability. They can spread the liability between the owners, but they're still individually, each partner is jointly and severally liable for all of the debts and losses. Traditionally, they set up an agreement to decide how they're going to split their profits, which a sole trader doesn't have to do. And it doesn't say it on this slide, but partnership accounts are private as well. They do not get published. People can't see them. Third type of business, limited liability company, which is the most important one as far as the syllabus is concerned. Limited liability company is a separate legal entity from its owners. So the shareholders and the company are legally separate. The owners have limited liability. This means they are not personally liable for the company's debts and losses. The company is liable for its own debts and losses. The owners are only liable for the amount they've invested in the company. So if you invest £1 or $1 in a company, that's all you're subject to lose. Company continues a separate legal entity, continues to exist regardless of the identity of its owners. Capital withdrawal with the company is formalised. There's a set process you need to go through, and it's not called drawings, it's called dividends. Financial statements must be produced and must be provided for shareholders, because the shareholders need to know what's going on with the business that they own. And there's an agency relationship, which we talk about a little bit later. Companies are managed by a board of directors who decide what the company is going to do, but they're owned by shareholders. So the ownership and the management are separate, whereas with the other two types of company, the ownership and the management are the same. Pros and cons: sole trader, quick and easy to set up, very low reporting requirements. The disadvantage, the con, is really unlimited liability. The owner will suffer for all of the debts and losses. Partnership, again, relatively quick and easy to set up, relatively easy for the owners, for additional owners to be added. You can incorporate another partner. Con, each part is still unlimited liability, so each partner is jointly and severally liable for all of the debts and losses. And also, I'd put arguments on there as well. Sometimes there are disputes between the partners as to how they should be running the business. Limited company, from the owner's point of view, low risk because of limited liability. You're only liable for the amount of cash you introduce. Cons, lots and lots of reporting requirements. Increased compliance burden. Increased compliance just means do as the law says. Increased compliance burden relating to capital and reporting. Legal differences. Sole trader, if sued, the owner is personally responsible. Audited financial statements aren't required. So I'm not saying these are positives or negatives. These are just summaries of the differences. Financial statements do not need to be publicly available. Sole trader pays taxes on income earned from their business. Capital withdrawal is nice and easy. They can just take out whatever they like. With the partnership, if sued, the partners are jointly and severally responsible, so they can split liability between them, but they're still responsible for all of the debts and losses. Like sole trader, audited financial statements are not required. Like a sole trader, financial statements do not need to be publicly available. Like a sole trader, each of the owners pays taxes on the income that they've earned, and capital withdrawal is relatively simple, especially if you've got a partnership agreement that tells you how much you've agreed to take out. Limited company, separate legal entity, can sue and be sued separately from its owners. So the owners are not individually liable for all of the debts and losses of the company. Must file accounts which are publicly available. Those financial accounts need to be audited, which means somebody comes along and says, yes, these are okay, or no, they're not. Company pays taxes separately from the shareholders, so the company pays taxes on profits. And withdrawing capital, which is dividends, subject to strict rules. There's only a certain amount of distribution of dividends that can be carried out. Why does this matter? Well, the business entity, the company, the type of business entity that you've got will impact the way in which the financial statements are presented. Sole traders, partnerships and limited companies have different capital structures. Therefore, the SOFP, the Statement of Financial Position, will look different depending on the type of entity used because of the equity section of the Statement of Financial Position. However, this point at the bottom is key. For accounting purposes, all three types of business are treated as being separate from their owners. Legally, there's no separation for a sole trader or a partnership, but there is for a limited company. But when we're recording the transactions, sole trader, partnership and a limited company are all treated as being separate business entities rather than separate legal entities. We've got a question. Which of the following statements are true about limited liability companies? Number 1, company's exposure to debt and other liabilities is limited. 2, financial statements must be produced. 3, can sue and be sued separately from its owners. 4, company continues to exist regardless of the identity of its owners. It says which of the following statements are true, so there's going to be more than one. Well, the answer is 2, 3 and 4. And the explanation for this is as follows. Read it really carefully. The company is exposed to the debts it arranges for itself. Okay, the company's exposure to debt and other liabilities is not limited. It's the owner's liability that's limited, not the company. So number 1 is not true. The others are though. So it's the owners of the company that have limited liability, not the company. So statement 1 is false. Financial statements must be produced and filed. That's true. Limited liability company can sue and be sued separately from its owners. That's true as well. Separate legal entity. And a limited company continues to exist even if the original owner transfers or sells their holding. So it doesn't matter who owns the company still exists. The shareholders and the company separate from each other.